This is Michigan's retirement coach, Mike Douglas.
When will the tariffs come all the way down to the price tags? That's what people want to know, Mike. If they haven't already, I don't know. The information.
When does it roll fully downhill? Is that what you're saying?
The information flying about when it comes to tariffs, not just about the effects, but how tariffs themselves, will they or won't. I feel like that's the new headline. Will he or won't he with the tariffs? Because they keep what's going to be implemented changes every day. I'm Heather Branch. This is Mike Douglas, certified financial planner, Michigan's retirement coach, here to share some insight on the Trump tariff conversation today is what we're going to talk about. MichigansRetirementCoach.com is where to go. If you have questions that you want to speak to Mike and his team directly about, we're ready to help you get some answers. We also have links posted in the show notes. With the tariffs, we have seen, obviously, the ever-changing news about them. Some have been reduced or even removed as trade deals evolve. Many are still in place. When could we feel their impact on what we buy is what a lot of people want to know. So economist Jeremy Siegel, he was on Fox Business, and he was saying that he thinks it's right about this time. Summertime is when we should start seeing the price tags be affected, and that the Fed should sit still. Here's what he said.
I don't think we're going to be seeing the effects of this tariff until maybe June or July. This is tariff-induced inflation. Long-term inflation rate indicators are not going up, and the Fed should not be reacting against a supply shock. It should be reacting against a demand shock, and we're not getting a demand shock either from the tariffs or the fiscal policy or money supply growth.
So, I mean, some of the stuff that he was saying, I guess, is good news, is that if we do see any kind of inflation, it should be short-lived. It's not real inflation. Meanwhile, Wall Street is, of course, reactive to all kinds of information around the tariff conversation, Mike. So, and for those who did get out of the market in April, they might be having some regrets right now. Of course, does this bring up the conversation now about people that are wanting to time the market? What would you say to anybody that brought up this idea to you?
Just when to time the market?
Yeah.
Oh, don't do it. Don't do it.
Well, first rule of Fight Club.
Yeah, don't talk about
Fight Club. First rule of market timing. Don't market time.
Yeah.
Yeah.
There's a great quote. Predicting rain is easy. Building arcs is tough. And that's kind of what we're talking about here. It's like, it's easy to say, oh, markets are bad, I want to get out.
Yeah.
But first of all, and I'm not someone like you have to lose all your money but as long as you hold the shares, you haven't lost. I do agree with that in a long-term view, but different phases of life have different sets of tolerance and capacity for that. So if I'm 65, 70, my thought process on holding the shares, so in 5 to 7 years I recover my assets, is different than someone who is 35, 40 in a 401k. So that's a little different, but market timing is really difficult. It's very challenging, and it's typically not a good idea. Market recalibration, if we see actual trends in the market, it doesn't mean you have to ride the whole roller coaster all the way down or all the way up. But the idea of just like, oh, it's down 6%, I'm out.
Like there's a difference
really
of reacting and responding. And it seems that market timing involves reaction. And what you're talking about, recalibration, understanding that a plan requires its own adjustments, that's the responding, and that's how we need to.
Well, the broad market does it, right? We shift from equities to fixed income and bonds, and then we go from fixed income back into equities, and that's the teeter-totter that we do as the market cycles move.
Yeah.
If I know for a fact that there's going to be a hyper volatile season, it's not a bad idea, especially if interest rates are high, to push towards fixed income a little bit. On the other hand, if I'm 30, 35, 40 years old and I'm trying to build a portfolio with highly growth motivated moments, I should be dumping into equities during a volatile down market because I'm buying shares at a discount and they're going to run up. So I don't think that stagnancy is a good tool during market cycles, nor do I think that bailing out is a good idea either. I just think we need to be strategic and know in the good times how we will react and move in the bad times. So as far as this type of stuff goes, when is the bottom? When is the bottom of the market? Well, it seems like we've already hit the bottom of the tariff movement, right? It took, from February 19th to basically the middle of April, about a 2-month rundown.
Yeah.
It runs down for the 2 months and then it's back up, not to the high point, but year to date, we're basically flat. Depending on the day, slightly above, slightly below. Not back to the high point of February 19th. So as we look at that, when's the bottom? And if you hit the bottom, most typically there's a huge recovery the next couple of days from the bottom and you would miss it. I think we want to start looking at for retirees, because whenever I put these out, right, someone comes in the comments and starts just chirping with like keyboard muscles about, oh, well, did you know I did this and this? I said, well, are you 65 or are you 35? Because the advice is different. Right. So if you are near retirement or in retirement and you're looking at your investments, you may want to start segmenting in terms of time frame.
Okay.
Not asset class.
Okay.
So over the next 5 years, like once we've secured the actual income I live off of my lifestyle and make sure that my monthly lifestyle needs and it's all covered. Then once we start looking at our savings beyond that, what money will I need for the next 5 years? Do I have a big trip coming up, renovations coming up? Do I have a roof that needs to be done? Whatever it is, that money that is needed should be a little bit more conservative. That way, if the market tanks, it's there. I had someone who had some pretty big renovation plans and travel plans to Italy and to do a whole deck on the backside of their house in 2020.
Okay. In 2020?
2020.
Okay.
So they tell me this in November of 2019. So as we came into 2020, I took that portion of money and de-risked it and put it into much more conservative, knowing that they were going to need it soon, not knowing COVID was coming, not knowing the crash was coming. And the timing of when they needed it, they were doing the deck in May of 2020.
Okay.
So the market had not fully recovered yet. It was on the way up, but it hadn't recovered. Well, what I had done is I took the $40,000 they needed for the renovations, put it into a more conservative portfolio. Therefore, when everything tanked, it didn't really hardly lose anything, and it was still there for them when they needed it.
Okay.
However, it didn't participate in some of the gains of January and February. It didn't participate in the 33% crash of February, March, and then it didn't participate in the recovery of April. It just was there when they needed it. Now, the rest of their portfolio that was targeted out for 6, 10, 15, 20 years out from now, that was in. And we tried to be really opportunistic with certain things during that time frame. But understanding that maybe once you get towards retirement, not when you're young, when you get towards retirement, start thinking of what do I need? What are my necessities for the next 1 to 5 years? Keep that money more conservative. Then when these market cycles come, tariffs happen, the tech and bond fall out of 2022, all types of stuff. When those things happen, well, I know that my cruise next year isn't in danger. I know that my kitchen remodel is not in danger. It's not going to be like that scene of Big Daddy. Do you remember that in Big Daddy when they're walking through the grocery store?
I never saw it.
Oh my God. So it's a great scene, right? So he's walking around with this kid and they smash the can on the ground because the market performed poorly and they get discount on damaged goods. And so he was like, oh, the market's down. So he smashes the can on the ground so they get discounted green beans or whatever it was.
Okay.
And the whole, like, we don't want to live our life that way in retirement.
Right. Of course.
The stuff I need right now, just keep it safe. Yeah. Keep it available, keep it liquid, and get me better than inflation. That would be the kind of the goal.
Okay.
Then the money that's 6 to 10, 15 years out, that's a little bit more aggressive.
Okay.
And then understanding that young money and old money are built differently, what their time frame is. And just because you are a senior or in or near retirement doesn't mean that your money should be invested as old money. I had a client who came through, and as we're talking through, she was sitting on about $2.5 to $3 million. And she said, there's no way I'm going to spend this stuff. Most of this is going to end up in my kids' hands. So how should we invest it? We took about $1 million and said, you'll never even spend this $1 million. Then the balance we invested as though the kids were going to own it. And so it had a much higher risk profile, a much higher risk tolerance. And it really was able to accomplish quite a few things over 7 to 8 years before she ended up passing. Okay. And that way, when it went to them, because it was already earmarked for them, it had really rapidly grown because it was invested as young money, not as old money. She lived on old money. It was invested for them as young money. So I think there's some thought there to understand where we go. Going back to the tariff specifically, this is how we deal with market cycles. Yeah. Right. The tariffs, we know it's a black swan type of event for now. Mm-hmm. It's a spike down with uncertainty, and it's really come up basically all the way back up, not from the peak, but to the year-to-date numbers. And we just have seen April and May tariff revenue numbers came in very high. Like, it's not strictly just it is a bargaining chip, and we don't know exactly how it's being used fully right now. Mm-hmm. But the tariff revenue generated, go Google the charts of tariff revenue generated in April and May. Like you'll see like our regular revenue of tariffs as a country over the past 30 years. And all of a sudden you see bang, like a steep spike up April, May. If that is a long play, that affects our country situation as a whole. If it's a short-term play, it doesn't really affect it. But some things have a downstream effect on the rest of us. Some things don't. Some things affect the company, not the consumer. Other things affect the consumer, not the company. So we're kind of navigating those waters. Mm-hmm. But the core principle being, if we can generate revenue by taxing other countries more, we don't have to tax our people as much. Mm-hmm. That is what has been communicated as the core principle by Lutnick, by Bensett, by President Trump. Like, if we can tax other countries and not tax our people, that would be ideal. Mm-hmm. Okay. If that worked, that'd be great. We'll see what happens. We're still very early in the experiment. But, you know, I think we oftentimes complain that government workers don't do anything, that politicians are just there collecting paychecks and promoting their own stuff. Mm-hmm. So if nothing else, it's entertaining, right? Like, you know,
best reality TV ever.
2016 to 2020, we're like, man, you didn't have to wonder what President Trump was thinking because he told you all the time.
Right.
And the amount of press conferences as a president done, very high. I mean, daily press conferences during COVID, like out in front all the time.
Yep.
And you kind of get this like comfort, like, oh, this is what access to the president looks like. And it's all this good, bad, ugly, whatever, not a taking a stance, but he was out there all the time. Then we go President Biden's 4 years, and we're like, we rarely ever hear from him because he's got a team and cabinet, whatever. They're all speaking, and we never hear from him. And then now all of a sudden, he's back, baby. We got President Trump out front doing stuff, you know, running and gunning.
Yep.
Got a lot of content. For podcasters, man, there's a lot of stuff we can talk about here.
The podcasters, I think anybody that has a platform is eating it up. And to your point, it's whatever side you lean on, doesn't matter. It just facts. Yeah.
I mean, the fact is this. Tariff revenue just went way up. As a country, we made a lot of money in the last 2 months.
Okay.
Now, is that sustainable? Yeah. I don't know. Will it roll downhill on some stuff? Consumption tax is interesting because we want our cake and we eat it too. We want to eat it too, right? Like I don't want to pay income tax, but I also don't want to pay consumption tax.
Right.
So like, it seems like I can either pay taxes on my income and then not pay tax on the stuff I buy, but then they still hit me with sales tax on non-grocery items. And so would you rather be taxed on your income, or would you rather say, well, if I buy this, I know there's a consumption tax built in, so maybe I won't buy that.
I think that for so many people, they feel like they're getting it from all angles. So, Mike, I think that's
the
big
real
problem. And then thinking about the folks that are listening to this podcast at a certain phase of life and retirement, it's just like, I have paid so much in taxes. This conversation, it's just a whirlwind, and everything is just whipping around me. And I feel like for so many retirees, I mean, I'm 45 years old and I already feel this way. It's like, I just want to have my money and just leave me alone. Just leave me alone. Just here's my money. I'm good. Leave me alone.
I just met with someone, and he and I come from very different political ideologies. We still have great discussions. He's an attorney, really good guy. And as we're talking through, we had this exact conversation. He was like, here's the problem. Do I like the idea of no income taxes? Absolutely. But I'm retired and I paid income taxes my whole life. And now that I'm retired and not receiving income, now you want to shift me to a consumption tax? And he was talking about, there was a guy from Georgia who was presenting the fair tax for a long time. Mm-hmm. And actually the attorney was from Kennesaw.
Okay.
And as we were talking, he was like, yeah, this fair tax was presented year over year, trying to get it pushed through. And the idea being a consumption-based tax system where you only pay taxes when you buy stuff.
Okay.
Never on income.
Yeah.
Which sounds great, except for when you spent 50 years in the workforce paying income tax.
Yep.
And now they say, we're going to shift you to consumbtion tax.
And it's like, hello.
You got me coming and you got me going.
Yep.
Why are we doing this? And so I think that there's a potential, there's a nugget out there that says, wow, if this works and we could lower income taxes, that would be really, really great.
Yeah.
And that's like the hope that we could hold on to.
Yeah.
Because nobody thinks we should pay more in taxes.
Right.
Well, I shouldn't say nobody. Most people don't think we should be paying more in taxes, right?
Depends on the politician you're talking to.
Right. I feel like most of us are like, I want to pay my fair share. Like, I want my teachers paid. I want my
the
firemen and policemen
infrastructure.
paid.
I want to support the military. I want the bridges to be secure.
I think politicians are overpaid.
I agree.
You know, that whole model, I think they should be a actual service job, not a way to get rich.
Yep.
But outside of that, like, common sense across the board says we need some level of taxes to pay for the things.
Yep.
But the system's not good now.
Right.
Because I pay income tax. I pay sales tax. I pay property tax. I just quit taxing me.
Yep. Taxes.
So for retirees, everywhere. You're even feeling more strapped and more trapped in it because I'm not even earning money and they keep taxing me. They tax my Social Security. They raise my Medicare premiums if I make too much money.
Yeah.
They tax me on RMDs. They tax me everywhere. So we don't know where it's going to go. But as far as market timing and tariffs go, don't do it.
I think
segment in time frames and be responsive, not reactive.
Right. It's safe to say, correct me if I'm wrong, tariffs are just the thing right now. It's the conversation right now. And for people that are getting into retirement, this is the thing that we're dealing with. If you retired 5 years ago, you were dealing with the pandemic and that effect. If you were retiring in 2008, you were dealing with the housing market crashing and the bank's crashing. If you were dealing in retiring in 2000, you didn't even know you were getting ready to deal with a lost decade, but you were dealing with the crashing of the market. And then coming out of the 90s when the market was on fire, man. And then you retired in the year 2000. It was a rough go for a lot of people. Mm-hmm. The lessons learned of all those times is that it's always going to be something. There's always going to be something there. So creating a plan to add layers of protection. And again, it's like the idea, put the little wall around yourself, the little moat around you and your money. Here's my money. Here's me. Leave me alone. Yeah. This is the kind of plan that we need to work around these things because it's always going to be something. It's always going to be something. Yeah. That's just what I've finally just succumbed to. So,
and on top of that, I mean, the baby boomer generation, largest generation in history, transferring the largest amount of wealth in history. Yep. Trillions of dollars transferring from baby boomers to their beneficiaries. Yep. The government is going to keep tightening the circle, tightening the noose, trying to like just squeeze everything they possibly can out of baby boomers' wealth before it gets to the next generation, because then they have to wait another 15, 20 years to get it. Mm-hmm. So build a moat.
They got an eye on you. Mm-hmm. Protect yourself. MichigansRetirementCoach.com is our website. If you want to talk to Mike about how you can do this, build the moat around your castle. He is here to help you figure out what your options are. We also have links posted in the show notes. Let's get to work. Or again, it's MichigansRetirementCoach.com.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.